Welcome to AARO Academy. In this video, we will explore the essential aspects of IFRS 2 share-based payment transactions. We'll cover classification, vesting conditions, recognition, measurement, disclosures, and provide practical examples to help you understand these concepts. Let's dive in. IFRS 2 requires all entities to recognize share-based payment transactions in their financial statements. This standard applies to transactions where an entity receives goods or services in exchange for equity instruments like shares or share options, or cash based on the value of its equity instruments. However, IFRS 2 does not apply to equity instruments issued in business combinations or certain commodity contracts. What exactly are share-based payment transactions?
Let's explore what share-based payment transactions entail under IFRS 2. These transactions are a key aspect of how entities account for compensation and other forms of consideration. Specifically, IFRS 2 covers transactions where an entity receives goods or services, and the payment is based on the value of the entity's equity instruments, such as shares or share options, or cash that reflects the value of those instruments. IFRS 2 provides detailed guidance on how to classify, recognize, and measure these transactions, ensuring that financial statements accurately capture the financial impact of share-based payments. This includes distinguishing between equity-settled and cash-settled transactions, understanding the treatment of vesting conditions, and addressing the complexities of group share-based payment arrangements.
Next, let's discuss classification. The question goes, how are share-based payment transactions classified?
Share-based payment transactions are classified as either equity-settled or cash-settled. Equity-settled transactions involve the entity issuing its own equity instruments, while cash-settled transactions require the entity to transfer cash or other assets based on the value of its equity instruments. Additionally, some transactions provide either the entity or the counterparty with the choice of whether the transaction is settled in cash or equity.
Vesting conditions play a crucial role in share-based payment transactions. My questions are, what are vesting conditions? And what about non-vesting conditions?
Vesting conditions determine when the counterparty becomes entitled to the share-based payment. These conditions can be service-based or performance-based. Non-vesting conditions do not affect the vesting of the award, but may influence the ultimate payout. It is important to distinguish between market and non-market performance conditions, as they impact the measurement and recognition of share-based payments differently.
One of the key aspects of IFRS 2 is the recognition and measurement of share-based payments. My questions are, how are share-based payments recognized and measured? And how is the fair value estimated?
IFRS 2 requires that an entity recognizes the goods or services received or acquired in a share-based payment transaction when it obtains them. The corresponding expense or asset is recognized over the vesting period. For equity-settled transactions, the fair value is measured at the grant date, while for cash-settled transactions, it is remeasured at each reporting date. To estimate fair value, entities often use models like Black-Scholes, binomial, or Monte Carlo, considering factors such as expected volatility, risk-free interest rate, and expected dividends. Allow me to follow this up with an example. Suppose a company grants 100 share options to its employees, with each option valued at $15, vesting over 3 years. The company expects all options to vest. The expense recognized each period would be calculated as follows. To calculate the expense, we need to divide the total value of the share options by the number of vesting periods. In this case, the total value of the options is 100 options times $15 per option equals to $1.50. Since the options vest over 3 years, and we typically recognize the expense on a semi-annual basis, 6 periods, we divide $1,500 by 6 periods. Let me also explain the journal entry in more detail. In the first period, we recognize an expense of $250. The journal entry would be a debit share option expense of $250 and credit equity of $250. This means we are debiting the share option expense account to recognize the expense and crediting the equity account to reflect the issuance of the share options. In each of the subsequent periods, we continue to recognize the same expense of $250. This ensures that the total expense recognized over the vesting period accurately reflects the fair value of the share options granted to the employees. If some options do not vest, the company would adjust the total expense recognized to reflect the actual number of options that vest. For instance, if only 90 options vest, the total expense would be adjusted to 90 options times $15 equals $1,350, and the expense per period would be adjusted accordingly.
Thanks for that detailed example on equity-settled share-based payments. Now, let's talk about cash-settled share-based payments. Unlike equity-settled transactions, where changes are recognized in equity, cash-settled share-based payments require the recognition of a liability. This liability is remeasured at each reporting date, reflecting the obligation to settle the payment in cash.
Let me show you yet another example. For a cash-settled share-based payment, let's assume the company grants share appreciation rights that entitle employees to cash payments based on the increase in the company's share price. The fair value of the liability is remeasured at each reporting date. First, we measure the fair value of the share appreciation rights at the grant date, which is $10,000 in our example. Then, at each reporting date, we remeasure the fair value of the liability. Suppose at the first reporting date, the fair value has increased to $12,000. The increase of $2,000 is recognized as an expense. If the fair value decreases, we recognize a reduction in the liability and a corresponding reduction in the expense. For instance, if the fair value at the next reporting date drops to $11,000, the decrease of $1,000 is recognized as follows. Understanding these basic calculations is crucial, but there's much more to explore. For an in-depth discussion on the various measurement approaches, including the models we've mentioned, we invite you to join our detailed training sessions at AARO Academy. Dive deeper into how these models work, when to apply them, and the implications for financial reporting.
Now, let us look at modifications, cancellations, and how settlements can complicate the accounting for share-based payments. My question is, what happens when the terms of a share-based payment are modified, canceled, or settled?
Let's consider a scenario where the terms of an equity-settled award are modified to increase its fair value. Suppose a company originally granted 100 share options valued at $10 each, vesting over 4 years. After 2 years, the company modifies the award, increasing the fair value to $12 per option. The incremental fair value is $2 per option, which is recognized over the remaining 2 years of the vesting period. So, the company will recognize an additional $100 each year. If an award is canceled early, the company must recognize any remaining unrecognized expense immediately. For instance, if the company cancels the award after 2 years with $500 unrecognized, it must recognize this amount immediately. However, it's crucial to note that the total expense recognized each year includes both the original grant's expense and this new incremental amount. So, for the 3rd and 4th years, the company will recognize a total expense of $350 each year. This total reflects both the original and the incremental expenses.
Thank you. Moving on with the next question, what information must be disclosed under IFRS 2?
IFRS 2 requires entities to disclose detailed information about share-based payment arrangements. This includes the nature and extent of these arrangements, the methods used to determine fair value, and the impact on the entity's financial position and performance. Proper disclosures ensure transparency and help stakeholders understand the financial implications of share-based payments.
In conclusion, IFRS 2 provides comprehensive guidance on accounting for share-based payments.
Absolutely. It's essential for entities to consider classification, recognition, measurement principles, and extensive disclosure requirements. Understanding these aspects is crucial for accurate financial reporting. Additionally, deferred tax implications and the treatment of non-employee transactions should not be overlooked.
Agreed. Properly understanding IFRS 2 ensures transparency and accuracy in financial statements, benefiting both the entity and its stakeholders.
Thank you for watching this AARO Academy video. We hope you found it informative and helpful. Don't forget to subscribe for more informative videos. See you next time!
Bye.